Today, we're diving into a golden mystery that has captivated the attention of economic analysts worldwide. We're talking about Russian gold, a phenomenon that over the years has raised eyebrows and questions alike. A record amount of gold has been flowing out of Russia, heading straight to London. But the question is this merely a strategy to reap massive profits and exploit favorable market conditions? Or is there something far deeper at play? Could the Russian elite have been quietly preparing a financial lifeboat for themselves in the heart of the British capital? To unravel this enigma, we'll reference a February 2021 analysis by Sargrad, featuring insights from columnist Yuri Pronko and economic director Valentin Katasonov. First, let's set the historical stage. In 2020, the export of Russian gold hit astonishing levels. 320 tons, valued at $18.50 billion, most of it destined for London. This was more than 3 times the volume of 2019. To put that in perspective, in September 2020 alone, nearly 55 tons of Russian gold bars were exported, triple the amount from August 2020 and 5 times more than September 2018. Looking back at the broader timeline, Russia exported a mere 10 tons to the UK in 2018. By 2020, that number had surged 32 times in just 2 years. Even the Central Bank of Russia joined this gold frenzy. For the first time since 2007, it sold over a ton of gold from its reserves in the third quarter of 2020. At that time, gold represented just under 23% of Russia's total reserves, with the remainder in foreign currencies, government bonds, and corporate debt. Now let's talk about the surprising move by the Ministry of Finance. While hundreds of tons of gold were being flown to London, Finance Minister Anton Siluanov proposed altering the investment structure of the National Wealth Fund. Historically, the NWF had been invested primarily in US dollars, euros, and British pounds. Siluanov suggested allocating part of the fund to gold bars, an abrupt reversal from his 2019 stance when he had criticized gold investments for their low liquidity and difficulty of rapid conversion into cash if needed. Pronko asked Katasonov a critical question. Why the sudden shift? Katasonov believes Siluanov's change in position relates directly to new anti-Russian sanctions. Government officials and the central bank recognized that insufficient measures had been taken over previous years to reduce Russia's dependency on external shocks. This was in 2020-2021, a time when macroeconomic stability was still a fragile facade. Katasonov highlights a crucial fact. Physical gold stored in Russia cannot be seized. This is not the case for foreign currency reserves, which the central bank keeps in overseas banks or government bonds. The contrast between assets at home and abroad would become bitterly significant in the coming years. So, is the Russian gold flowing to London merely a profit-making venture, or a secret haven for the elite? Katasonov answers in essence that it's a give-and-take game. Russian monetary authorities continue to support foreign currencies, US dollars, euros, British pounds, yen, and Chinese yuan. Yet starting April 1, 2020, the central bank stopped purchasing Russian gold. Meanwhile, the Ministry of Finance kept taxing investment gold transactions, effectively suppressing a domestic gold market. Russia lacked a vibrant internal market for gold. Citizens had no incentive to convert their vast cash holdings, estimated at $80 billion in physical currency, into gold. For comparison, China eliminated its investment gold VAT in the 2000s, rapidly boosting production to 500 tons annually, while benefiting the state treasury through taxes paid by miners. Russia, by contrast, remained constrained. Despite Siluanov's talk of adding gold to the NWF, Katasonov compares this to a debate from 20 years prior about including gold in the stabilization fund, never implemented. Essentially, no real policy change was forthcoming during Siluanov's tenure. Meanwhile, other countries were buying gold aggressively. Turkey, with modest production, bought far more than its annual output. China imported substantial gold annually to meet domestic demand. Russia, by contrast, remained restrained. Here's the paradox. While Russian elites exported gold to London, domestic policies stifled the creation of a robust internal gold market. Dependence on foreign currency and vulnerability to sanctions loomed large. This set the stage for a radical shift, the liberation of Russian gold from London. Fast forward to recent developments. Laura Aboli reports a monumental change. Russian gold is breaking free from London. Russia is preparing to launch its own gold trading platform in St. Petersburg. completely independent of the London Bullion Market Association. This move severs Russian gold pricing from Western financial cartels, striking directly at the heart of the global financial order. London, as Aboli notes, isn't just a city, it's the epicenter of centuries-old financial control. The City of London Corporation, a private entity immune to UK law, led by unelected financiers, including the Rothschild dynasty and their successors, has manipulated gold, credit, and war as tools of subjugation for over 300 years. Russia's move is both strategic and symbolic. The era of pricing global wealth through manipulated Western markets is ending. The old gods of debt and dominance no longer dictate the rules. If Russia's new gold exchange succeeds, it could expose the paper gold fraud that, according to theory, sustains London and Wall Street, where more gold is traded in contracts than exists physically. By promoting physical gold trade among Eastern nations, Russia aligns with BRICS and the Shanghai Cooperation Organization, SCO, in their quest for de-dollarization and an alternative to Western-dominated financial systems. This shift challenges the petrodollar complex and undermines London's deep-rooted control. SPIMEX, the St. Petersburg International Mercantile Exchange, will launch trading for key commodities, including gold. Igor Chernychev, SPIMEX's CEO, states that Russia aims to establish national price indicators independent of international benchmarks, balancing supply and demand within its domestic market. Why now? The answer lies at the intersection of pre-existing concerns and recent geopolitical shocks. The 2022 sanctions imposed after the Ukraine conflict froze hundreds of billions of euros in Russian central bank assets, mostly held in Western institutions like Euroclear. As Katasonov predicted, physical gold in Russia was immune, while foreign currency and bonds were vulnerable. A prophetic insight turned reality. Restrictions on Russian gold imports followed. The G7, EU, UK, US, Canada, and Japan banned imports of newly mined or refined Russian gold, effectively closing access to London markets. Russia needed an alternative, and fast. The creation of the St. Petersburg Exchange addresses three key objectives: reducing dependency on the West, fostering de-dollarization and multipolarity, and encouraging domestic markets while linking with non-Western partners. BRICS nations now have a platform for physical gold trade outside Western control, supporting diversification and reducing dollar reliance. In March 2022, the Russian central bank resumed buying gold from commercial banks at a fixed price of 5,000 rubles per gram, incentivizing domestic production and accumulation. Russia became the largest purchaser of its own mined gold globally, reinforcing gold as a secure strategic asset. Discussions of a BRICS common currency backed by commodities, including gold, highlight its pivotal role as both a trade commodity and a cornerstone for a new international monetary system. The European Central Bank notes that gold has surpassed the euro as the second most traded financial commodity after the US dollar, underscoring the metal's growing global significance amid uncertainty and declining trust in fiat currencies. Geo listeners, what we're witnessing is the culmination of years of Russian efforts to reduce Western financial dependence, a process accelerated dramatically by sanctions. By establishing its own gold trading platform, Russia aims not only to optimize profits and safeguard assets, but to challenge London's financial hegemony and the dollar's global dominance. From rivers of gold flowing to London to sovereign financial independence, Russian gold's journey is a masterclass in geopolitical strategy. This story reveals the transformation of the global financial order and the rise of a multipolar system. The massive gold flows of 2018-2020 raised questions, but the post-2022 developments signal a deliberate pivot. The NWF's initial reforms, Katasanov's warnings about domestic market inadequacies, and the ultimate launch of the St. Petersburg Exchange reflect a cohesive strategy to secure national wealth and assert financial sovereignty. Rising domestic gold purchases, BRICS engagement, and physical gold trade symbolize a new era, one where gold, not paper, underpins economic stability and global trust. In a world where sanctions are wielded as economic weapons, Russia and its allies are laying the foundation for a parallel financial system, anchored in physical gold and mutual confidence, rather than Western dominance. The implications for the future of the dollar, the euro, and global power balance are immense. Will this strategy stabilize Russia while empowering a multipolar world? Only time will tell. But one thing is clear: the era of Western monopoly over gold pricing and financial control is being challenged, and Russia's golden pivot is leading the charge. So, Geo listeners, That's the report on Russian gold, a geopolitical economic bombshell that's reshaping the Western establishment. With China reducing U.S. debt holdings and sanctions disrupting Western markets, the global order faces unprecedented shifts. Thank you for joining me. Don't forget to like the video, subscribe if you're new here, and, as always, seek the truth. Stay alert, stay informed, and stay together. Until next time.